Well, at that time, I had 2 clinics. I had my chiropractic student loans from chiropractic school. I had the house that I lived in. I also had a house on the Lake of the Ozarks between St. Louis and Kansas City. And if you have a house on the lake, Kyle, guess what you have to have? You got to have a boat and a wave runner.
Oh, yeah.
You can't have a boat and a wave runner or a house on the lake without a boat and a wave runner.
Absolutely.
I'm also an airplane pilot. So as an airplane pilot, I had to have my own airplane. So it didn't take me a lot to become almost $1 million in debt. Well, I was able to put this concept into place, and I was able to pay that debt off in 39 months, 3 years and 3 months. And all I did was I added one step to my financial life. I didn't have to change my cash flow, didn't have to work any harder, take any additional risk or lose control. I added one step.
This is my time. I'm on the right.
Hi, I'm Kyle Stephenson, and you're listening to the Assets and Orthopedics Podcast. In this forum, we hope to educate medical students, residents, physicians, and other high-income professionals on the power of investing, especially in real estate assets and syndications. We want to help providers gain financial intelligence with the hope of earning financial freedom. Please listen and learn so you can spend more time doing what you love with who you love. Enjoy the podcast.
I go 100 all day.
Hello and welcome to the Assets and Orthopedics Podcast. This is your host, Kyle Stephenson. I'm excited to introduce you all to our next guest, Mr. Brent Kessler. How you doing, sir?
Hey, I'm doing great, Kyle. Great to be on, man. Thanks for having me. Excited to share today.
Yeah, we really appreciate you coming on, sir. And I know you are a chiropractor by trade. And so should I call you Dr. Kessler?
No. So call me Brent.
Okay.
If it's all right, I'm going to call you Kyle.
Absolutely. Please. Yes, sir. All right. So, Brent, I'm going to give a introduction real quick, and then I will let you kind of take us on your journey.
Got it.
Awesome. All right. So, Brent was a chiropractor, as I just mentioned, and chiropractic coach for over 14 years. After implementing the Money Multiplier, TMM method, Brent paid off $984,000 and some change in third-party debt in 39 months. I think a lot of us physicians can understand where he's coming from on that. So, in fact, Brent became so passionate about how powerful this concept was, he had began sharing it with others. It was when his previous mentor told him he had successfully referred over 41 new clients into the system that Brent took his advice and started the journey to becoming a teacher of the TMM method. His main goal in making this move was simply to help more people understand how to manage and grow their wealth. For the last 10 years, Brent has been lecturing thousands of people around the country on dynamics of the TMM method, which we're going to dive deep into on this episode. And he teaches how to take back control of your financial life, which is what we're all about, especially as physicians and high-income performers and professionals. Brent has a passionate belief that whether you make $10 an hour or $10,000 an hour, you should know this method. So this method is powerful. It's powerful information to keep control of your own money. So with that being said, Brent, we're going to dive into that method. And your website shares a lot, which is awesome. But please tell us about your early years, how you got started. Maybe, did you tell us about chiropractic school? Just something that we can all, kind of relate to.
Yeah, absolutely. So yeah, kind of like what you said, man. So this concept changed my financial life, and here's where I was. Well, okay, so just to give you a little bit of background, yes, I am a chiropractor, no longer practice chiropractic anymore. I own 5 chiropractic clinics in the Kansas City area. I sold my last clinic in 2017. I have not been practicing in the chiropractic field since 2008. I had associate doctors, and the majority of my office is that I sold those offices to the chiropractors that were in there as associates, right? And it was kind of just like crazy the way it happened. I started out with my first associate doc because I wanted to free up some of my time and I wanted to open up another clinic. And then, so that went so well with having that associate that all my future associates, I had those associates train the new associates. So I really only trained 1-2 associates, and then all the other ones that came through were trained by the associates that I trained. So I was really able, to leverage my time, right? So just to give you a little bit of background, went to chiropractic college in St. Louis. So back in 2006, I was at a chiropractic conference and I heard somebody talk about this thing called the infinite banking concept, how to become your own banker. And I was there and I listened to it and I'm like, man, this is really, really cool, but it just sounds too good to be true, right? I'm sure you've seen things like that where it looks good and it just seems too good to be true. Well, the thing I did is I left that conference and I did nothing at all with the information that I heard. I went back to my normal chiropractic life. I go back to another chiropractic conference a couple years later in 2008. And about 10 or 12 of my colleagues that were at the previous conference are now at this conference with me. The only difference between them and me is they heard this information and they acted upon it. So they were coming up to me. They were basically going on and on how they were able to build their wealth, pay off their debt, recapture, recycle their money, because at that time, so the average chiropractor came out of debt like $280,000 in student loan debt. And then you had to go open up a clinic or associate with someone or something like that. So anyway, they were going on and on about this, how this concept was working for them, basically throwing up all over me about it. And so I thought to myself, right, there has to be something to this. There's no way 10 or 12 of my colleagues are lying to me. Maybe one or two, but not 10 or 12, right? So I come home and I tell my wife, I said, honey, we have to start implementing this concept in our life. And it was in February of 2008. And I found myself $984,711 in third-party debt. That's what I owed the third party. Now, I know what you're thinking. You're thinking, well, how do you know that amount? Well, that was part of the exercise. I had to know what that amount was, almost $1 million in debt. And I know you're thinking, all right, well, how do you get that amount in debt? Because I know, right, the thing is in Kansas, to have $1 million back then, it bought you a lot of stuff. Now, I understand if you have, so I understand if you're in California, that buys you a very small house, but in California, it buys you a lot. Well, at that time, I had 2 clinics. I had my chiropractic student loans from chiropractic school. I had the house that I lived in. I also had a house on the Lake of the Ozarks between St. Louis and Kansas City. And if you have a house on the lake, Kyle, guess what you have to have? You got to have a boat in the wave run.
Oh, yeah.
You can't have a boat in the wave run or a house on the lake without a boat in the wave run.
Absolutely.
I'm also an airplane pilot. So as an airplane pilot, I had to have my own airplane. So it didn't take me a lot to become almost $1 million in debt. Well, I was able to put this concept into place and I was able to pay that debt off in 39 months, 3 years and 3 months. And all I did was I added one step to my financial life. I didn't have to change my cash flow, didn't have to work any harder, take any additional risk or lose control. I added one step. Well, anyway, just to fast forward a bit more, I became really passionate about this, and I started teaching this concept in March of 2012. And now, so here we are today talking in November of 2024, so 12 and a half years. Okay, so I've been teaching probably between 50 to 70 live events a year, 100 to 120 Zoom virtual events. I do a lot of events. I do events with dentists, orthodontists, chiropractors, network marketers, people in the real estate world. Before we came on, I was telling you, I've spoken on the Grant Cardone stages, the Ed Milet stages. So Pace Morby is a client of mine. Pace Morby actively does this, promotes me and has me and my daughter, Hannah, who, if you like podcasts, go to the Money Multiplier podcast. My daughter's 25 years old. She has 130 plus episodes, records a new one every week. Her podcast just recently, a few months ago, went live on iHeartRadio. Our website is called themoneymultiplier.com. I go over a full presentation. I have a full recorded 90-minute presentation with downloadable examples and attachments of how this concept works that I teach. So I started teaching this in 2012, and now, right, we're kind of at the point where everybody that I teach or talk to, it comes from a referral, from someone else, right? It's kind of like I asked you earlier today, hey man, so like, how did we hook up? How did we, get together? Because I do so many podcasts and stuff, right? So it's all like word of mouth and referral and stuff like that. But the thing we do is we teach people how to build, keep, and create wealth through their own debts and expenses that they already have. And the concept that we use is a concept called the infinite banking concept. Now, I did not invent this concept, okay? So like there's a guy that wrote this book. It's called Becoming Your Own Banker. And the guy that wrote this book, his name is R. Nelson Nash. And R. Nelson Nash, he lived in Birmingham, Alabama. And this was my mentor. My mentor was R. Nelson Nash. Now, R. Nelson Nash passed away a little over 5.5 years ago, March of 2019, at age 87 years old. This book completely changed my financial life. This is a book that you want to add to your wealth building library, right? Now, I wrote a book called Mapping Out the Millionaire Mystery. I think we wrote it in 2019 or 2020. And I wrote this with a client who is now a colleague of mine. His name is Chris Naugle. Now, a lot of you guys, especially in the real estate world, you may know who Chris Naugle is. If you don't, just go out and punch in chrisnaugle.com. Naugle, Naugle. He lives in Buffalo, New York. He's very active in the real estate industry. He's had a couple shows on TV, one on House Hunters, another one on HGTV called Risky Builders. And I'll just throw this out there, Kyle. I will send this ebook to any of your listeners or community that want it. All you got to do is go to our website, themoneymultiplier.com. I think you can download the book there, or send me an email, Brent@themoneymultiplier.com, and I'll send you, the ebook version of that book. Okay.
Amazing.
So I wrote that book, but again, Nelson Nash and this concept, the infinite banking concept, is really the concept that I teach. He is my mentor, and this is the concept that I teach. And I help people, again, to recapture, recycle all the money that goes out to other people. Because see, here's where we're at. It's just not physicians, chiropractors, MDs, dentists, orthodontists, real estate gurus, right? The majority of us, or a lot of us, do really, really good at making money, but we suck at keeping money.
Absolutely.
Doctors are probably just one of the worst at keeping money because they buy so much crap, right? I mean, have you ever played that Robert Kiyosaki game, that Purple Monopoly?
The cash flow? Oh, yeah.
Right. So, like, have you ever noticed the janitor and the truck drivers are the ones with all the money, and the doctors or the attorneys are the ones that go broke, right?
Oh, yeah.
Again, the thing we do is we suck at keeping that money. So I teach you how to build, keep, and create wealth through your own debts and expenses that you already have. For example, let's just use a car, for example, okay? Everybody drives a car, so you have to buy a car probably. And even though I don't know, like the community, right, that's on today, I know how you buy cars. You buy cars one of three ways. You pay cash, you bank finance, or you lease the car. Because I know you guys probably didn't steal the car, right? So what you had to do is you had to give money to the car dealer, and the car dealer gives you the car. So the car dealer gets the money, you get the car, transaction is over, everybody goes home happy. Yes? Well, how about if there's a way that you can add one simple step in your financial life, and not only do you get the car that you just bought, but now you're able to recycle and recapture and get all of that money back. So you have the money and the car. I show you in detail how to do that on my 90-plus minute presentation. And if I can show you how to get all the money back for a car, guess what else you can get it back for? You can get it back for any product or service, a boat, a bicycle. You can get it back for a TV, a chandelier, a piano, right? Anything that you buy, any product or service that you buy, you can recycle your money. I own 5 clinics. So I had to buy x-ray film. I had to buy rehab and therapy and modality equipment. I had to buy headrest paper, right? We're chiropractors. You lay your head down, and then it's kind of rude to have the next patient lay down on the same headrest paper that the last patient lay down. So you got to roll the headrest paper, right? So any product or service that you're buying for your office, any like payroll that you're paying your employees, Malpractice insurance. I mean, I'm a chiropractor, so I didn't pay a lot of malpractice insurance. But MDs and like DOs and all that, you guys pay a boatload of malpractice insurance.
Oh, yeah.
Well, when you pay that, that money is gone forever. It's left your family. How about if we start using the tools that the wealthy have been using for over 200 years? Because look, as I said, Kyle, I didn't invent this concept. And R. Nelson Nash, that wrote this book, didn't invent the concept. It's been around for over 250 years. If you go research the Rockefellers, okay, the Rothschilds, the Morgans, the Stanleys, the Barclays, go out and research how Walt Disney built Disneyland, how Ray Kroc funded McDonald's, how Pampered Chef got started before Warren Buffett bought Pampered Chef. This is the tools that they use to build wealth. Go out there. There's a guy named Robert Kiyosaki. He's famous for a book called Rich Dad, Poor Dad. He wrote a book called Second Chance. In that book, Second Chance, the concept that I teach is exactly what Robert Kiyosaki talks about. Tony Robbins wrote a book called Money Master the Game. In chapter 5.4 of that Tony Robbins book, this is the concept that I teach. He talks about it in that book. The problem with those guys talking about it in those books is they make it too difficult and complicated to understand. So when most people read through it, they read right through it and don't know what the next steps are to do. And they forget what they read and they just move on to the next book or something else in their life. So I break it down into very easy, simple to understand as far as how to use it. Now, I will tell you, I have over 17,000 clients in every state of this country. So never take my word for how I treat people or how people like what they do with us. Go out and Google my name, Brent Kessler with one S. Google the Money Multiplier. You go look at yourself at the case designs, the plan designs, the success stories, the testimonials. So don't take my word for it, right? Go out and look at all of that. Now, let me give you a big overall view of how the concept works from a 30,000 foot view. All right. Again, remember, the thing we're doing is we're using the tools that the wealthy are using. So I'm not reinventing the wheel. I am not reinventing the wheel. I'm only using the tools that the wealthy have been using for over 200 plus years. And I'm going to imitate and mimic exactly what they're doing. And I'm building wealth right along with them. And I have no problems with sharing you my numbers, what I do, my investments, how I build, keep, and create money. I mean, I'll get down to the nitty gritty with you. I have no shame at all in that whatsoever. But if you think about the guy named Warren Buffett, here's what Warren Buffett says. Well, before I say that, okay, all the tools that we have to use, okay, there's all these financial tools that we have to use. Okay, there's the wealthy and there's us. There's the wealthy and there's us. And we all have access to the same financial tools. The only difference between us and the super wealthy is they use the tools differently than we do. And I just know how to play the game now, right? So I don't know when Warren Buffett said this, but back in October 2008, that is so good. No, don't edit, man. This is TV, man. Let's just keep it like it is. I hope you don't edit this. But anyway, back in 2008, in October of 2008, I don't know if this is when he said it, but this is when I heard it. And I think about this quote every day of my life. And the quote was by Warren Buffett. And Warren Buffett said, if poor people would just start doing what rich people do, they wouldn't be poor anymore. How much sense does that make? So all we're going to do is mimic and imitate what the wealthy do. So now let me give you the 30,000 foot view. The tool that we're going to use to build, keep, and create wealth. I'm going to tell you what that machine is in just a minute. It's going to surprise a lot of people. As a matter of fact, I'm going to turn off a lot of people when I say this, okay? But don't turn off. Just hear me out for a minute because I know you guys are going to click the off button. You're going to go walk the dog, burp the baby, or maybe a couple of you will put clothes on your babies.
Yeah.
But don't turn it off, all right? But anyway, just hear me out. The tool that we're going to use to build, keep, and create wealth is a whole life insurance policy in a mutual company that pays dividends. Now, I know what you're thinking. You're thinking of what? A whole life in policy? why on earth would I ever want to use a whole life policy to build wealth? As a matter of fact, you're thinking, I know everything there is to know about whole life insurance, and that is a horrible way. It is a horrible way to build wealth because Dave Ramsey and Susie Orman told me it was horrible, right? Well, you don't know everything because if you did, you would be implementing this in your life. Now, let me be clear. This is not any type of policy. No, 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 no. This is not the policy that you can buy from your brother-in-law that sells life insurance. No, no, right? We all have a brother-in-law that sells life insurance. This is a specially engineered, specifically designed whole life policy in a mutual company that pays dividends that is designed for high immediate cash value. One more time. High immediate cash value. So what that means is when you put money into this policy, you immediately have cash value to use. And my definition of immediately is within 30 days. Now, the reason that you don't know or hear about these policies is because most insurance agents don't understand how this works. And even if they did, Kyle, they don't really want you doing this type of policy. And the reason being is because in order to design your policy this way, to make it work in this fashion, the insurance agent has to take a 60 to a 90% cut in their commission. And they're not willing to do it.
Oh, okay.
They're not willing to do it. Now, I want to go one step further. You never, ever, no clients, 17,000 plus clients in every state of the country. And I also work in Canada too, but I have a colleague that works with you in Canada that not me, Brent Kessler, but I have a very, very good Canadian colleague that does the same thing. So if you live in Canada, that the problem is solved there. Okay. But I know what people are asking or probably thinking. And even after they watch my presentation, they're going to say, oh my gosh, this looks really good. I haven't heard about it before. Why haven't I heard about it before? And they're going to think this must cost a fortune for me to start and do this in my financial life. You never, never, never pay me a dime or my company, the Money Multiplier dime. Nobody has ever paid me a dime. Here's how I get paid, Kyle. I get paid one way only. I get paid the same way that your car insurance guy or gal gets paid. For example, if you go to John Smith, the Allstate man, to buy car insurance, you don't write a check to John Smith or to John Smith. You write a check to Allstate, and Allstate pays John Smith a commission. So I get paid a commission on the policy that you start. I don't determine what my commission is, and you, the client, don't determine what my commission is. But I already told you that I take a 60 to 90% cut because of the way we design the policy for high cash value. So that is the big overall view. That is the product that we're using. And when you use the policy, when you add that step, and so keep in mind, most of my clients or most people don't only have one policy. They get multiple policies. You start with one, but then you get multiple policies, right? I think to date I have 28 policies. I put over $1 million a year into my premium. I buy at least one policy every 1 to 2 years. I will tell you, I have clients that have way more policies than I do, and I have clients that pay way more premium than I do. This is just what I do. I think I'm pretty close on these numbers, but out of the 17,000 clients, of those, 91% of those that have been with us for a year or longer have more than one policy, and about 70% of those come back before the first year to buy additional policies. And why do they do that? Because they see how effective this works and how efficient our team works with them. And the one question that I know somebody's asking right now is, well, why can't you just have one policy and do it all? Because each policy is a contract. And as your life progresses, your wealth usually builds, and you can't overfill a policy. So like I'm holding a 10-ounce glass of water. Let's just make believe this is 10 ounces. I can never get 12 ounces of water in this glass, no matter how hard I try. So if I overfill the water, it'll all seep out. If you overfill your policy with cash, then what happens is it becomes this thing called a MEC, MEC, which stands for Modified Endowment Contract. Now, not that the audience needs to know this, but this thing MEC came about, I think it was June of 1988 or 1998. I don't know why I'm drawing about 88 or 98. So this thing called a MEC, because all these people were trying to stuff money into their policies. And the government was like, wait, all these people are stuffing money in their policies. And of course, anything that works good for the people, the government wants to come in and say, no, we got to stop that. How can we stop that, or how can we get a piece of it? So what they did is they came in and they created this thing called a MEC. And it says if you overfill your policy now is no longer treated as an insurance contract. It's treated as an investment, and it's subject to taxation. So the way we build and design the policy is we snuggle it right up to the MEC line without going over it. And when you want to put more money into the policy, you're not going to put it in that same one. You're going to go put it in policy 2, 3, 4, or whatnot, and start other policies. It's almost like the bank where you bank at, Kyle, in Indianapolis, Indiana. There's not just one branch of your bank. There's multiple branches, right? There's multiple branches. So can you have multiple banks or branches in your own financial life? Yes. And those are multiple policies.
Fantastic. That is a lot of good information. Let me just say a couple things, and then we'll continue on this. So I started diving deep. I thought I dove deep, but not deep enough, into cash value life insurance. Is that similar?
It is. Okay, but keep in mind, it is not a term policy. It's not a UL. It's not an IUL. It's not an index universal. It's not a variable. It is a specifically designed, specially engineered whole life policy in a mutual company that pays dividends. And right there at your back door, there's a big company called One America. When you go downtown, you see the big One America buildings. Sometimes it's referred to as American United Life. That is one of the best companies for this concept that we use. A great, fantastic company. Now, I use more companies than them, but they are a great company.
Okay. So with that being said, I read this book, and it's called Money Wealth Life Insurance. Can you see that?
Yes. Anyway, who wrote it?
Jake Thompson. And it was all about cash value life insurance. So it's whole life insurance. Sounds similar to what you're talking about. You could be your own bank. You put money in each month, and then you could withdraw from that. You could take loans from it.
Yeah.
And it was all tax free. Right? So similar thing, right? Where you could take loans out that are tax free.
Yeah, absolutely. So yes, you are right. I just want to clarify, when you say loans, you take out loans tax free. Remember, a loan, there's never tax on a loan. You've never paid tax on a loan.
Sure.
If the thing you do is change that loan to a withdrawal, then it could create a taxable event if it's above and beyond cost basis. A loan, and that's exactly how we teach you to do this, is to take policy loans and not withdrawals for a lot of reasons, that being one of them. But a policy loan is not taxable. But a policy withdrawal would be taxable if it was above and beyond cost basis.
That's right. So yeah, withdrawal, you have to replace, or a withdrawal would be taxed essentially over a certain amount. A loan is not taxed.
Correct.
And you don't necessarily have to put that loan back, but it's going to decrease your death benefit. Is that correct?
No, it doesn't decrease your death benefit. Because a loan is a prepayment of the death benefit. So let's hypothetically say that on your policy, your death benefit was $1 million. And let's say you had $600,000 of cash value. Okay. If you take out all $600,000 in the cash value, and all of a sudden you die, pass, graduate, whichever word you like to use. I like to use the word graduate, right? Now what happens is that $1 million death benefit will pay off the $600,000 loan, because they gave you the $600,000 while you were living, and the additional $400,000 goes to your beneficiaries. So all the million is still there. They just gave you $600 in advance. So Kyle, how cool is that? We're essentially using a portion of our death benefit while we're living instead of us having to leave all the death benefit to our ungrateful children.
That's right.
Or am I the only one that has ungrateful children?
Yeah, right. No, yours are have taken over the torch, so they're obviously very grateful. All right, so I love this. This is fantastic. I did dive deep, and I talked to some guys about it who were getting me on board, and I was just diving deep myself, trying to read, and I wish I would have talked to you earlier, but this is good. I'm at an age now where this is.
It's a game changer.
Yeah.
Even if you don't like me or you don't like my personality or my bald head, figure out how to implement this in your life. But yes, you're going to have to use an agent. You're going to have to use somebody that does this. And there is nobody on this planet that does more infinite banking business than what we do at the Money Multiplier. Nobody on this planet. And I'll tell you why. Because we constantly serve the community. I'm a big believer in what the late Zig Ziglar said. Now, I'm age 57 years old, and I started reading Zig Ziglar in the 8th grade. There was a class it might have been the 7th grade. I was in middle school, and there was this class called ICAN, I-C-A-N. And it was all based on these books by Zig Ziglar. And I remember Zig Ziglar, he says, help enough other people get what they want, and you end up getting what you want. So here's what we do as a team on our team, the Money Multiplier. I have a complete team, and it's called the implementation team. So the thing that our team does is design your policy tools. We design things called it's called the Money Multiplier Map, the cash flow analysis, all tools that if you go to the website, themoneymultiplier.com and watch my presentation, you'll understand those tools. There's additional tools out there as well. We have the debt blaster, the gains projector. There's all these different kind of tools. So what our team does when you are a client of us on the Money Multiplier, we are constantly updating your tools, not just once and we're done. It's 2 to 3 times a year, every 4 to 6 months. Because here's why we do that. Because, okay, Kyle, just right now, exactly where you are today in your financial life is not where you were 6 months, a year ago, 2 years, 5 years ago. And it's not going to be where you're at 6 months from now, a year, 2, 5, 10 years down the road, because you're going to go through your financial life. You buy things, sell things, windfalls, downfalls, raises, demotions, right? Your financial life changes. So as your financial life changes, we have to alter your financial tools based on what's going on in your financial life. And we provide that service to you, and you never, ever, ever pay us a dime for any of that. Now, a lot of people ask me, they say, Brent, why do you spend all that money paying all those people on your implementation team to continue to serve on policies that they've already bought? Well, here's why. Because you are going to see the power of how this works, because the more you're around the campfire and drink the Kool-Aid, and guess what you're going to do, Kyle? You're going to refer your friends, your coworkers, your colleagues, your families, and maybe you might even refer people you don't like. And you're also going to see, oh my gosh, look how this is working in my financial life. I better start more of these for myself and my family. So those 2 kids that I just saw running back behind you, they don't even know how their financial life is going to be changed when you start and implement this concept. They don't have a clue. But when you implement this concept, and remember, you don't have to do it with me, but you better check it out. Everybody that's listening should at least go check it out and say, oh my gosh, there's no way it could work that way. I'm going to close the book and never look at it again. But this is a game changer in your financial life. Because Kyle, listen, when you start keeping more of the money that you're making, it is a closed system. There's no money being leaked out to other people. Kyle, and did you know the average American spends 34.5 cents of every dollar they make goes out to interest to somebody else. 34.5 cents. That money goes out to interest. Can you imagine just keeping that money in your family? Could you imagine just keeping what you make instead of all of that money going out? Right now, all of your physicians are doing this. The thing they do is they go out, they buy insurance, they buy x-ray film, they pay staff, they pay office overhead, rent, credit card bills, whatever it is, personal or business. And whenever you put that money on a credit card or write a check for it, that money is gone forever. It is gone. It has left your family forever. So all we're going to do is add one financial step. I don't want you to change your cash flow. I don't want you to work any harder, take any additional risk, or lose control. I want you to add one step in your financial life. Page 48 of this book. Here's what Nelson Nash says. Let me tell you, it always sounds a bit strange to people when I say premium and income should match. That means, what that means is eventually the amount of policy premium that you pay into your policy should equal your income. So if you make $100,000 a year, you should pay $100,000 a year in premium. He says, let's start with a very basic fact. He says, all your money goes through someone else's bank now, right? And when you get your paycheck, what do you do with it? You deposit into someone else's bank. Then you write checks against it to buy all the things in life that you want. While it's in the bank, the banker lends your money out to someone else and makes a very good living doing it.
Yep.
Well, why don't you control the banking function in your life? That's what it's all about. Controlling the banking function in your life.
Yep, that's genius. So to that point, I would say a lot of people, probably 90% of people don't even know about this. I started diving into it a little bit, like I said, and I was like, man, this is mind-blowing. I feel like the wealthy are doing this stuff. But the more people I talk to, I called a guy, his parents are good friends with my parents who own a big business. The son takes care of their account, okay? So I called him and asked him about it. He's like, I don't know much about it. I just, we keep money in the stock market. That's basically what we're doing. I was very surprised to hear that because I thought somebody that needs to maintain wealth or store wealth, like this would be a perfect opportunity for that too, right? It's becoming your own bank.
Yeah. So let me hit on a couple of those things. Okay. So I told you my mentor Nelson Nash wrote Becoming Your Own Banker. He also wrote this other book called The Case for IBC. He wrote a third book, Building Your Warehouse of Wealth. So this is where we're storing our money. So let me just tell you what I do, Brent Kessler. Okay. I want to be transparent with you. I don't put any money in a 401k, an IRA, or qualified plan. And in my presentation, I go through why not. Okay. I don't do any of that. I don't buy Bitcoin. I don't buy gold and silver. I have some old gold and silver that I still have from before I even knew about this concept that I'm just too lazy to go and sell and turn in, honestly, right? But I have some old stuff. I store my wealth inside of my life insurance policies. That's my warehouse of where I store wealth. Now, I still invest because the thing you got to remember, a life insurance policy is not an investment.
Right. It's like 5% or something like that, right?
Well, yeah, it has a guaranteed growth rate plus dividend of a minimum of 4% tax-free. But remember, it's not about the rate, it's about the volume. And that's what, and actually in this book on page 69, that's what Nelson talks about too. It's not about the rate, it's the volume. A lot of people get hung up in rate, okay? So as far as the policy is not an investment, a lot of people think it's an investment because it builds, it grows. It's guaranteed to go up in value. It can never go down. It can never go down. Don't take my word for it. It is in your policy contract. Nobody in your state of Indiana, my state, or Florida, or any state in this country has ever lost money in a whole life policy in a mutual company that pays dividend. It's never happened. Go look it up, okay? But a lot of people think it's an investment because it goes up. Well, the true definition of an investment is something that goes up and goes down. The life insurance policy can never go down. So I add this step in my financial life, put the money in the policy, and then from the policy, I use that money to make my investments. Now, I do a lot of investing in the real estate world. I don't buy as many houses anymore as I used to, but I do short-term rentals. I do long-term rentals. I do Airbnbs. I do VRBOs, right? But now what I do primarily over the last probably 3-4 years, I do a lot of lending. I lend on real estate, okay? As I sit here today, I think I have $10.3 million loaned out for like 19 different people, some more than one loan, but I do it on real estate, and I have the collateral of the real estate, and I'm in first position. I even have a t-shirt, Kyle, that says if you're not first, you're last. Okay. I have done second position stuff in the past. I've done it. I'm not telling you not to do it. I just don't want to do it anymore because I don't want to be second. Okay.
Yeah.
So that's what I do. So here's what happens. I lend that money out. That interest money comes into me, right? That money, interest payments come into me. I can choose to pay back my policy loans because remember, I borrowed the money from the general fund of the insurance company, right? So, and actually, here's another key point. Whenever you take your money out of the life insurance policy, you don't take your own money. No. You simply put your policy up for collateral and take a loan from the general fund of the insurance company. So your money is continuing to compound and grow, and you're using it at the same time. Uninterrupted compound interest. There's no interruption of the compound interest. So essentially, Kyle, what you're doing is you're using your money and it's growing at the same time. So you're making money more than once on your money, right? Because not only do I make the money inside of my policy, I lend it out. And as that money comes back to me, I have a choice. I could put that money back into my policy as those loan payments come back, but I usually don't do that. I look for more lending opportunities. I want to keep that money working. Here's what my wife always says. My wife will always ask me about once a quarter. She'll say, "Honey, how much cash value do we have in our life insurance policies?" And if I tell her a number that's too high, she gets a little irritated. She says, "No. I don't want all that cash value in the life insurance policies. You get that money working. I want my green men working. If anybody's going to not work, if anybody's going to sit on the couch and eat bonbons, it's going to be me and not the green men. So get the money out there working." This concept shows you how to use that money over and over and over again. I'm going to give you one other resource. There's a guy, his name is Devin Burr. And he's on TikTok, Instagram, Twitter, all that social media stuff I don't know how to use, but it's under Mr. Burr, MR_BRRRR. So 4R. So Devin has all these videos. He's a real estate investor in Phoenix.
Burr is in buy, rent, rehab. Buy, rehab, rent, repeat.
However, his name, though, like his real name is Devin Burr. It's spelled Burr, but his TikTok and Twitter or whatever Facebook handle is Mr. MR_Burr. Well, what Devin does is he has tons of videos out there. And again, he's a client. And Devin shows you how he buys all of his real estate, and he uses the same money over and over and over and over again to do it, using this concept I'm telling you about.
Genius. All right, a couple things. So, because I've talked to a couple people, insurance brokers, do you use the big companies, the New York Life and the Northwestern Mutual or Mass Mutual?
Yeah, so we have 5 primary companies that we use, and I'm going to go ahead and name them for you now. The one is called One America, which is sometimes called American United Life in Indianapolis. Another one is called Lafayette Life, which is a company associated with Western and Southern. They're headquartered in Cincinnati, Ohio. There's another one called Guardian. There's another one called Penn Mutual. And there's another one called Security Mutual Life of New York. They're located up in a town called Binghamton, New York, near Syracuse. And then we use Mass Mutual as well. The reason that we don't use New York Life and the reason we don't use Northwestern Mutual, not that they're bad companies, they don't allow you to design the policies the way that you want them designed for that high immediate cash value. And they also don't want you taking loans immediately from those policies. So there are reasons that we don't use them. And so let me just give you just an example of Northwestern Mutual. Northwestern Mutual does not like their clients practicing the infinite banking concept, which it's crazy because the money is your money. But see, the problem with Northwestern Mutual is they think that when you pay premium, it's their money. and they want to use it the way they want to use it. But see, you have first right to your money because it is a mutual company that pays dividends. So anytime you pay premium, the insurance company can use the money for whatever they want to use it for. But when you come knocking on the door and you say, hey, Mr. Insurance Company, I want to use my cash value, you are first in line. Nobody outranks you. No matter where they have that money, they have to give it to you first. But they would rather not loan it to you. They would rather use it for stuff that they want to do. So Northwestern Mutual and New York Life are not good companies practice the infinite banking concept. And I'm open to anybody that wants to write me, text me, email me, and challenge me. And if they can show me differently, then I've got 2 ears and 1 mouth. God gave me 2 ears and 1 mouth. I can be listening twice as much as I'm talking. I'm still trying to learn that trait. But if somebody can show me why and how these policies can be structured with their products, I'm an open book. But I've never seen it up to this point.
This is fascinating. I mean, this really is. I love this stuff. Yeah, I'm going to get these books. I think all of our readers need to get these books. We can get on your website, listen to the 90-minute presentation. And then what do you think? So a couple of things. Would you get a policy for yourself, your wife, and can you do it for your kids as well?
Absolutely. All of the above.
Even naked 3 and 2-year-olds?
Even naked. Yeah, absolutely. You should. Look, there's no better gift a parent can give a child, a grandparent can give a grandchild, than the gift of a cash value whole life policy in a mutual company that's designed, that is specifically designed and specially engineered for high cash value. There's no better gift. I have policies. I have grandchildren. I have policies on my grandchildren. I have kids, and my one kid works in the business. I have policies on them. My oldest son, I do not have a policy on. He was born with bad kidneys. He had a kidney transplant. He is not insurable, has never been insurable. Even when he was born it's almost 36 years ago, he couldn't even got a policy then, even though I didn't know about this 36 years ago. But there's policies on his wife. There's policies on his 2 children, which are my grandchildren. So you can own policies on people that you have a vested interest in, family members, even like employees, like I own policies on my chiropractic associate docs. I can own policies on people that I lend money to. If you think about it, if you ever go, and I know a lot of the docs on this call listening, they have went to a bank before to start their business. And what kind of loan did they get? They got an SBA loan, a Small Business Association loan. What did the bank make you do? The bank made you take an insurance policy out on yourself. They made you pay for that policy because if something happens and you die before that loan is paid off, the bank wants to make sure they get paid. I remember buying a boat one time. And you had, not a boat, but I was going to refer to the boat as if you buy a boat and you have a mortgage, on the boat, you have to name them as the lost payee, right, on the insurance, right? They want to make sure they get paid. But as a doctor opening up a clinic, I mean, it's a brand new clinic, or maybe it's an existing clinic. They don't know that you're going to go in there and be successful. You may buy an existing clinic and run it into the ground. Just because you have the word doctor in front of your name doesn't mean you know how to run a business.
No, absolutely not.
Actually, most doctors don't know how to run a business. And I don't know about MD or DO school, but in chiropractic school, they didn't teach us jack crap about running a business.
Yeah, I was going to say that at your conferences, they actually teach you about business. At our conferences, it's all medicine. We don't learn anything about business. So.
Well, yes. You're right. Our conferences are business, but I'm talking about chiropractic school. Or like DO school or MD school, right?
You're correct. Yep. And that's why we do these podcasts, to get, experts like you on to help these guys out.
Yes. So anyway, like my son's girlfriend, my youngest son is 23. He's a pilot for NetJets. He flies NetJets. He flies jets. And his girlfriend that lives in Altoona, Pennsylvania, she is a physician's assistant about to graduate here in May, right? She's doing her last of her rotations now. They never taught her a thing about dude, all this school. All right. So it was after my son started dating her that she even understood really what a credit card was and how to use a credit card.
Oh yeah.
You had to teach her how to use a credit card. They don't teach you crap about business. And G says nothing at all about business.
You're right. So Robert Kiyosaki talks about it all the time. Well, first of all, he says that doctors and lawyers are some of the poorest people out there, right? Because expense creep. Like you make money, but you're taxed at basically 50%, and then the expenses catch up to the rest of it. So you're living paycheck to paycheck. B, schools don't want to teach you about all this stuff because, you're supposed to be a working class individual, right? Yes, ma'am, no, sir. And just work and listen, work factory job, basically. It's essentially what it's for.
And then in addition to that, I mean, again, all right, so I don't know really how it is today, because I sold my last clinic in 2017.
It's probably the exact same.
So how about the reimbursement that you get from these insurance carriers and the Medicare and all of that? They limit you. They're telling you what should happen. They're telling you what should happen with care. So I never forget, there was a patient that came in one time and he had a problem with his leg. Okay. He had a problem with his leg. And here's what they told him. They said, well, Mr. Patient, your insurance will cover the amputation of the leg, but they won't cover the care of your leg. So if you want to get it amputated, however, it is fixable probably. We can solve the problem, but your insurance won't pay for the ongoing continuous treatment that you need for the leg, but they will cover the amputation. I mean, and again, even as time passes on, all the reimbursements are cut. They want you to see, they want to give you very little reimbursement. I don't know how docs can survive in the insurance world. I don't know how they can survive with third-party payers.
Yep, it gets worse every year. And I did a podcast on this talking about how income's going down. So over the last 20 years, inflation went up 50%. Doctor salaries only went up 10%. So we're losing money every year. And then with insurance on top of that and EMR systems, and the burnout rate is extremely high. I'll just put it that way.
Oh, absolutely. And you're exactly right. The EMR system, because they want you to keep every detailed record and they want it in their format. And it just trying to keep the records of your patients is expensive because you have to use all that advanced technology to do it.
Yep, exactly. So real quick, I love this stuff. I'm going to definitely hop on your website. I'm more intrigued the more you talk. I'm going to do a little self-plug. My business partner and I, we have some hotels down in Louisiana, and we're going to continue to grow that. But we're going to start a coaching program / mastermind called our Exit Strategy Mastermind. And we already got some speakers lined up for next summer. We're going to do a conference, our Exit Strategy Conference. And I think a speaker like you would be phenomenal. It would be awesome it sounds like you come to Indianapolis quite a bit anyways, right? So
I do. But even if I'm not going to your town or city, we'll get away to either. I travel all around the country. I have my own airplane and my own pilot. That's how much I travel. And guess what? On that airplane, I got that airplane sitting out in the hangar, that $3.1 million airplane. And actually, I'm a big Kansas City Chiefs fan, so I'm going to Buffalo this Sunday in that airplane to watch the Chiefs and the Bills. But yes, in that airplane, just like I show you on my presentation, how to get all the money back for every car you're going to buy, drive, and own. So not only do you get the car and the money, I do the same thing on the airplane. It doesn't matter what the price is. You're recapturing, recycling money, and you're keeping that money inside of the family. It is a game changer, and we would love to speak and sponsor the event that you're doing. And I'm telling you, Kyle, people are going to love this information. They will come up to you and they will say, oh my gosh, that is such great financial information. And all I do is teach. I don't ever ask you to buy a thing. I'm just pouring into you content of how this concept works. And hopefully, if you like what we say and you decide to implement this concept in your life, you'll do it with us at the Money Multiplier. If you don't, there's other people out to do it with too.
Sure. But you guys got it dialed in. I mean, I'm calling your implementation team ASAP, because it sounds like you guys got it dialed in, and I'm excited to learn much, much more personally. But Mr. Brent, we are going to finish with 4 questions that I like to ask my guest. Besides your own book, what book are you reading right now?
You know, the book that I'm reading, I actually read the book Who Not How. And then, hey, Terry. Okay, so anyway, that book sitting on my table right there. What's that book called? Oh, The Gap and the Gain by Daniel Sullivan. That was written by Ben. The Gap and the Gain. Let me tell you, if you're a physician, read Who Not How. Read Who Not How by Daniel Sullivan, and read The Gap and the Gain by Daniel Sullivan. It was written by Ben. It was written by Benjamin Hardy, and that's kind of a long story. But when you read the book, you'll know why Ben Hardy wrote the book.
Oh, yes. He did it with Who Not How as well, right?
Yeah.
And also 10X is better than 2X.
Yes.
Okay. That's amazing. What advice would you give to your 25-year-old self?
Oh, my 25-year-old self, like my 25-year-old daughter that I talk to every day. A couple things. Pay attention, get excited, and never quit. So pay attention to what's going on. Have an open mind, too. You know, you can't be closed-minded, because people around you, they want you to conform to what they're doing. Sometimes you got to fire people in your life. And sometimes those people you got to fire are your friends and your family. And I know that sounds harsh, but your friends and your family will drag your ass down. So pay attention, get excited, and never quit. Pay attention, get excited, and never quit.
That's great. I have 2 more questions, but I want to stop there in between. Why is it that because you've talked about the Rothschilds and the Rockefellers and all these big names that have used this concept, why is it that people say so many bad things about whole life insurance? They're always like, get term life insurance, never get whole life insurance. And I never understood why, but that's always been the case, right? It has a negative connotation.
Right. And again, probably the person you're referring to mostly is Dave Ramsey. And I have some content out there to where what we've taken Dave Ramsey's stuff, me and Chris Noggle, and there's some content. There's some, like, if you want the video, I'll find it and I'll get it to you. But just about the stuff that Dave Ramsey says, it just isn't true. They don't understand they don't understand how it works. Now, keep in mind, this is not any life insurance policy, right? And also, when they're talking about this, they're talking about life insurance as an investment. Life insurance is not a good investment, and it's not meant to be an investment. Life insurance is the process that you're going to use to make your investments. And so, like, another thing I'll add is that, like, especially Dave Ramsey, what does he always tell you? Buy term and invest the rest. And Dave Ramsey says, live below your means. Now, have you ever Googled Dave Ramsey's house? And if you haven't, I suggest you go Google his house.
Probably massive though, right?
And just see what he's living in Tennessee. And here's the man telling you to live below your means. And you have to remember, Dave Ramsey has a very big a vested interest in a company called Zander Insurance Company, which is term life insurance. And the last thing I'll say is the thing you always hear: buy term and invest the rest. How many people do you know that are actually investing the rest? You know, so there's lots of other stuff that, like, on our video, we have a lot of podcasts and we have a lot of content and video, like as far as why whole life or instead of 401k. Well, it's not, okay. It's not instead of, it's not, okay. The thing we do not do, we don't tell people to do whole life and don't do other stuff. This is an addition to what you're already doing. Whatever you're doing that's working, continue to do it. This is adding one step in your financial life, not taking away anything you're doing, adding this one additional step. And when you do, your financial life is drastically going to improve.
I love it. I love it. All right, two last questions. What is your definition of wealth?
Well, as far as from a money standpoint, is just when your passive income is greater than your expenses. Everything that's all right, just as far as from a money standpoint, that's the definition of wealth. So when your passive income or your mailbox money or whatever it is great, or for example, your interest income coming in from all the investments that you have is greater than all the expenses that you have. And again, I'm in the life insurance business, so I see a lot of things with people in their health. It doesn't matter how much money that you have. If you don't have your health, all that money doesn't mean anything. And then we can get down into, the family dynamics of what the family, right? Because there's 7 areas in your life. You have your career, your financial, your spiritual, your health, your family, also your finances. I think that was 7. All of those you would love to have an equal balance at all times, but they never are they? You're always focused more on one and you let the other one slide. So I believe the true definition of wealth is when you have all of those areas in your life in equal balance. Very hard to do.
All right, last question here. Proverbs 11:25 states, "A generous person will prosper. Whoever refreshes others will be refreshed." It sounds like you're already doing this. You're making an impact. But if you could, if you could make a big impact by giving back, what would you or have you focused on?
Well, let me just tell you, the thing you do is when you keep more of your money, you have more money to give. And I am proud to say I have a foundation. I've created a foundation, and I give hundreds of thousands of dollars every year to charitable organizations. So let me give you a couple examples. So anyway, so remember a couple years ago, all the fires in
I want to say Lanai, but it's not Lanai. It's
I think it is something it's something like that. But anyway, because of that fire relief and what happened,
Lahaina.
Lahaina, because we're able to keep all the money in the family, we're able to give more. I gave $100,000 to fire relief.
Wow.
We gave $100,000 to the Leukemia and Lymphoma Society. Why? Because my brother, that is, let's see, I was born in 67. He was born in 74. He was diagnosed with non-Hodgkin's lymphoma, right? So, and then there's a lot of stuff that we do related to dogs. We like dogs and, charitable organizations that way. And we are now, before the end of the year, remember, I live in Florida, but just because I live in Florida, but it kind of hits home to me. If you know that like 2 years ago, we had Hurricane Ian, and in the last month, we had Hurricane Helene and Milton. And it tore up Florida, tore up North Carolina. So before the end of the year, we are donating money to hurricane relief. We haven't got the charitable organization yet set up that we're going to give to, but we're going to give multiple 6 figures of money to that hurricane relief. We just don't know yet. We haven't locked in what organization that we're going to do. But if you ask me before December, before the end of the year, I'll tell you what that is. And I'll tell you how much money that we actually are donating. And then there's other organizations out there that we that we give to. And the reason we're able to do that is because of being able to keep that money inside of the family. Here, anyway, I wanted to bring this up. You're talking about like as far as scripture and stuff. Well, Matthew 25 says, "You should have put my money on deposit with the bankers so that when I returned, I would have received it back with interest." So the Bible even talks about money, right? In all different areas and stuff. But yeah, man, again, all right. So kind of like what I said earlier, Kyle. So I live by what the late Zig Ziglar said: help enough other people get what they want, and you end up getting what you want. So it's about serving and helping people.
I love it. Brent, this has been a fascinating episode. I really, I'll be honest, I didn't know what to expect, and you blew my mind. And I think that you're blowing the listeners' minds. And I really encourage people to go to your website. I actually just filled out the form to get your book, so I'm going to start reading that tonight. Yeah, I'm intrigued by all this stuff, and I'm not going to lie, I did a little research and then I stopped. I was just like, I was a little turned off, just with the people I was dealing with. Nothing personal by any means, but I love what you're doing, and I know that there is a lot of power behind it. Infinite banking, basically using your own money as the bank, which is a genius move. So I'm excited to learn more about it and to get involved with your team and go further. So where can people find you?
Yeah, well, again, so the best place is go to the website, themoneymultiplier.com, or just send me an email, Brent, Brent, at the word money, multiplier.com. Brent at themoneymultiplier.com. That's my email. And then, of course, the website is themoneymultiplier.com.
Yep. And your daughter's podcast again?
Oh, my daughter's podcast is called the Money Multiplier Podcast. She drops a new episode every week. I think she's at 130, 140 episodes out there. She travels around the country, speaks on stage. But yeah, just go to the Money Multiplier Podcast, wherever you get it, and just watch her content. So she's very, very, very good. And she practices this and she lives this in her own life. She's 25 years old. She's bought 2 houses with this method. She's bought a couple cars. She's bought the new Bronco, the Ford Bronco, the limited edition. They only made 1,937 of these Broncos. Why did they make 1937? Because that's the year the Bronco came out, was 1937. She also loves to travel around in her van. She bought one of those conversion vans, kind of like an Amazon Prime van. Well, basically, she bought the raw version of the van, took it up to some guy in Nashville, Tennessee, and she spent I think it was like around $85,000 through policy money that we're talking about, because she recaptures and recycles it, and she totally customized that. She's single, and basically the thing, she has 2 cats. So in that van, it has cat boxes where the cats can pee and poop. Own designated a box, like an own designated box for their cats, like a little litter box. It has a shower. It has Wi-Fi. She travels around the country and she does a lot of her podcasts. Like when you watch some of her podcasts, she's traveling around in that van.
That is really cool. I was just thinking of this. Like I have my brother-in-law is a professional athlete. So I was just thinking professional athletes should be watching this. I think, definitely physicians, of course, chiropractors, dentists, but even the anybody else, right? I mean, it doesn't matter. To your point, it doesn't matter if you make $10 an hour or $10,000 an hour. Anybody can benefit from this, right?
Anybody. There is nobody that cannot benefit. And the earlier you start, the better. I mean, it doesn't matter if you're starting late. I mean, it is what it is. You are where you're at right now, right? So it's a game changer. Nobody, I mean, if anybody calls me, there might be a 0.5% chance that this is not going to work for you for some reason or another. But it's for everybody and everybody.
Awesome. All right. Well, when you're in Indianapolis next, please hit me up. I'd love to buy you coffee or drink or something, man. This is fascinating.
No, dude, we're doing coffee and drink. We're heading to St. Elmo's and we're going to get some shrimp cocktail. All right. That's where we're going. Now, I don't drink alcohol anymore, but I will drink one of those bourbon colas without the bourbon. And even though I don't drink, I will still eat one of those bourbon infused cherries. Have you ever had those?
Oh, yeah.
Oh, those bourbon infused cherries. I'm like, load me up with those cherries, man.
May not be able to walk when you get out of there, but yeah.
Yeah. Well, no, I don't do alcohol anymore. I'm done with alcohol just because I was like, no, I'm gonna stop drinking alcohol, and so quite honestly, probably one of the main reasons that I did it is because of my A1C level was getting high, and I was scared of 2 things primarily. I was scared of 2 things. Number one, I was afraid that I wasn't going to be able to get any more life insurance policies on my body, right? Because if your A1C is too high, they're not going to give you life insurance. And number two, I didn't want to lose my pilot's license.
Yeah.
And then, of course, my wife said to me, she says that she wants to keep me around a little longer. She's had me around for 30 years, and she said she'd like to try another 30 and see how it works.
Hey, impressive. 30 years is fantastic. You guys are killing it. You're a very interesting guy. I love it. Man, I hope a ton of my followers come to your website and jump on board. So we really appreciate it, and we'll be in touch here soon.
All right, Kyle, I'm here to serve your community in any way that I can, and looking forward to it. Thank you. Thank you so much for having me on. I know you have lots of choices and lots of guests that you can invite, and I'm honored that you allowed me to participate tonight. And hopefully this is the start of a great future relationship.
Absolutely. Yep. Thank you very much, Brent.
See you, Kyle. Bye-bye.
This is my time. I'm on the rise. Can't hold me down.
Thank you for listening. If you found value in today's podcast, please leave a review so our community can continue to grow. If you would like to stay connected or receive a copy of your free investing ebook, please go to www.sharpinvestmentsllc.com, and that's sharp with a P as in professional. This is not financial or tax advice. Please consult with your financial advisor or CPA.